Hey, welcome to the podcast. Today, I'm going to be talking about small cap stocks. What are small cap stocks and why should I invest in them or why should I not invest in them? So we're going to be going over all of the risks in investing into them. I actually had somebody question me about this and ask me these small cap stocks, why can't I invest in them? And people just don't seem to understand that these smaller companies just have way more risk than larger blue cap companies. Not blue cap, but large cap companies, mega cap companies like Amazon, that the smaller ones are just way riskier. There's much more likelihood, a much higher ratio that you're actually going to fail in the investment and lose money than actually gain money with smaller companies. So stay tuned, listen up, and at the end of it, I'm going to be giving you my own opinion on what a good small cap stock investment is. Heads up, it's an index fund. Since this is a dividend investment podcast, out of these small cap companies are going to be available for income as dividend investors like us. So stay tuned. Thanks for joining in and listening in. Now, I just want to get a question out there before I actually start talking on these small cap stocks areas. First off, I do invest in small cap stocks. So I may be making a video or a podcast right now saying that all the risks and the financial responsibilities that you take into account whenever you invest in small cap stocks, but that doesn't mean that I do not invest myself. I am more than willing to invest in small cap stocks myself. In fact, I actually encourage it. But when it comes down to it, am I going to skew more towards blue chip, safer companies? For a dividend investor like myself, yes, I will. And that's really what I want to talk about today. So some of the things I'm going to go over, first off, is what are small cap stocks. Now, on small cap stocks, I have a list here on the Motley Fool that they came out with that basically breaks up all the categories that small cap stocks are in. So for the first category of what they call micro cap companies, which are basically companies that are worth less than $300 million in market capitalization. Now, the next category up from there is what we are looking at, which is the small cap stock companies, or small cap companies. And they range between a market capitalization of $300 million to $2 billion. Now, $2 billion may not seem like it's a small amount, but in the world of American companies, that's actually pretty small. Most companies, if they start out doing very well, can get up to the 300 million mark to be considered a small cap company pretty dang quickly. So now that you know what an actual small cap company is, how are they riskier? Well, what makes them riskier? Now I was actually reading through this, and I was reading through this article that was written by John M. Longo, I believe. He is a PhD at Rutgers, or I believe he just teaches at Rutgers University. He teaches MBA degrees over there for financial investments. It may actually say what he does here. Yeah, so it looks like here he is a chartered financial analyst. He has a CFA certification. Basically, that just means that he went through a very long course. I believe it takes roughly a year, maybe 2 years, to get a CFA degree. It's something that I was actually looking into. But basically, he's very informed under investments in the finance and economics department. But he wrote down in this article this moment here that I'm going to read to you. So he said, and I quote, "Small cap stocks also tend to be more volatile and usually have a higher level of market risk or beta than large cap stocks. These firms are generally less established, have shakier financials, and often do not pay a dividend and therefore exhibit higher market risks. Also, small cap stocks have higher liquidity risks. So we'll go through this a little bit. Small cap stocks also tend to be more volatile and usually have a higher level of market risk or beta than a large cap stock. Now, large cap stocks, like we said, are in a higher category. And if you can actually see here, large cap companies go from the 10 billion to 200 billion range. So very, very larger, 100 times larger, in fact, than the small cap areas. But it says here, and usually have a higher level of market risk or beta than large cap stocks. So what is beta? Now, beta is often used in options trading, but it's basically just a measurement of the volatility of that company. If the company's stocks or price of the stock appreciates and depreciates a lot, then the beta is going to be, I believe it's much bigger. Now, if it has a smaller beta, then the line is going to be much, much shorter. So it's going to have a straighter line. You can kind of think of it as the R quantity in statistics. R is going to be closer to 0. So you could basically see it as regression in statistics. The closer R is to 1, it's going to have more of a correlation, and the closer R is to 0, it's not going to have a correlation at all. So the higher to 1, you could think of that as a lower beta, and if R has no correlation, or the closer to 0, then the beta is going to be much, much bigger. Kind of inverse. It gets a little bit confusing there, but just know that beta has to do with how volatile the stock is. Moving on, he said that these firms are generally less established. That's kind of self-explanatory. It just means that these companies aren't indoctrinated into whatever they're doing yet. So someone who just opened up compared to someone like Boeing. So Boeing makes these huge commercial airliners. It's extremely hard to get established into taking this. A new company who's going to come up, they have to buy all the specialized equipment, they have to buy all these materials, they have to set up contracts with all these different companies that probably have a contract set up with somebody else. The entrance into that corporation or into that specialization of making the huge airliners is extremely high. It's extremely high difficulty, which gives Boeing an advantage, but it makes these small cap stock companies a disadvantage. So that's what he means whenever he says that they're generally less established. They haven't established themselves yet. They have shakier financials. Most often, not all the time, but most often these smaller cap companies are going to have a bunch of debt on their balance sheets, and these balance sheets are what they're going to use, this debt is what they're going to use in order to establish their growth. They don't grow, what happens? Well, they go bankrupt. So they have all this debt, all this money that they took into, and they can't pay any of it back with the revenue that they've gained. So they end up going bankrupt. Often, as well, they do not pay a dividend. For a dividend investor, this can be very, very sad, obviously. So that's one of the downfalls of investing in small cap stocks. And like he said, he continues on, therefore they exhibit higher market risks. And also small cap stocks have higher liquidity risk. If you don't know what liquidity is, all it means is how easily available their money is. So like I said, back to the shakier financials, when a small cap company has a very high debt ratio, there's an extreme amount of debt, and not a lot of assets, they can't really sell any of those assets, get cash quickly, or they don't have a lot of cash on their balance sheet at hand, so therefore they don't have a lot of liquidity. So that's all it means is these small cap stocks are usually not going to be holding large amounts of cash, creating a safety net for themselves like other blue chip company stocks, for example, General Electric. So moving on to the next topic, small cap stock risks. Another run-up, I guess you could say, another bad thing that you could run into when investing in these small cap stocks is a lot of these companies, since they are smaller, are likely to be gobbled up or acquired by very large blue chip companies anyway. So, for example, if you're already investing in small cap stocks, you may not want to be held by a blue chip company, but you always have the possibility for them to come out that next Monday after you buy it, stating, "Hey, we're getting bought up by Chevron, or we're getting bought up by this General Electric, or we're getting bought up by Amazon, or whoever it is." And an example of this is right here, actually. This article that came up a couple days ago, saying that Chevron is going to be buying Noble Energy for $5 billion in an oil patch tie-up. So Noble Energy was a small cap stock beforehand, and now they are actually getting acquired by Chevron. So if you had no interest before in getting owned or owning Chevron, then you're kind of screwed. You're either going to have to sell your securities in Noble Energy whenever the transfer happens, or you're going to have to stick with whatever deal they come up with and then take the shares that Chevron gives you of whatever stock there is. Sometimes they make a separate stock for themselves. They'll make a sub stock for them, which tracks the Noble Energy, but it's all still going to be under the large Chevron corporation. So if you have no interest in that, that's a risk that you really have to take into account as well. So besides them being acquired, since these small cap stocks not really looked at as much as Chevron, for example, a lot of analysts are not going to be providing as much info on it as well. And they're not going to be providing their forward outlooks compared to somebody who has a huge spotlight on them like Tesla. Tesla actually has a lot of analysts on them, and they're also a huge publicity company. Noble Energy, a lot of people probably didn't even know what it was before this. Tesla, everybody knows what Tesla is. So that's another risk you have to take into account is if you do follow the analyst ratings, which a lot of people don't. I don't most of the time. I don't really factor it into when I do analyze my companies, but it's something that people do look at. There are jobs that pay millions of dollars for people to analyze companies, and that's what they do all day. So you could say they're experts at it. But if you have a company like Noble Energy, who has not very many people buying into it, it's not going to have very many analysts. And usually, the more analysts that are looking at a company, the more accurate information they can give on it, and the more predictability that the analysts come up with, they can give on it. Now, another thing that I wanted to come up with is this the small cap stocks, that another risk that you could come up into whenever you're investing in these compared to large blue chip stocks is usually the performance of them in history has not been the best, especially in the past 5 years. So this index is the Russell 200, or sorry, Russell 2000, and they don't. If we look at the past 5-year history of it, they've gained 29% in the past 5 years. In fact, in the last market hit back in March, I believe, yes, in March, they were still down the past 5-year chart of minus 16%. Now they're up 30%. So they are much more volatile, have a much higher beta investing than investing in these blue chip stocks. So if we take this Russell 2000, which, by the way, if I forgot to mention, it takes a 2,000 of the small cap stocks, small cap companies from, I believe, the New York Stock Exchange. I'll have to check on that. But you can guarantee that this index is going to track all small cap stocks. And over the time, this is how they've performed, is a 90% gain over the past 5 years. Now, if we look at the S&P 500, which is the top 500 blue chip companies normally, they have to be profitable in order to be on the exchange or on the index. Over the past 5 years, they've actually gained 60% in returns compared to the 29% before. Okay, so this is not really such a bad factor. It's not a bad return as well. Usually as an investor, you want to hit for 10% a year. That's pretty good when it comes to investing. And the S&P 500, which is a bunch of blue chip stock companies, they have been able to do that year over year as compared to small cap companies. They really haven't. Now, another thing you could take into account, though, with that being said, is another thing you have to take into account is at one point, all of these companies in the S&P 500 were at one point small cap companies. Now, if you invested in one of these companies that are now in the S&P 500 when they were still small cap companies, your growth potential was absolutely amazing. It was humongous. The growth potential is huge. But the possibility of you picking that company in the Russell 2000 or in the small cap company business is very, very low compared to all of them that actually do make it to the S&P 500. But if you do pick the right ones, you know how to analyze correctly, and you can pick the correct small cap companies. There's actually a lot of people who do pick the correct small cap companies. They know what they're doing and they do it well. A lot of hedge fund analysts as well. They are able to make a much better return than just, for example, say you invested in the regular index. Now, another thing that I wanted to go over was Warren Buffett, what he has to say on investing in smaller companies, smaller cap stocks, you could say, but just smaller companies in general. And if we listen here, basically what he says is he's so big right now, he doesn't even look at the small cap companies. So whenever I mention that the growth potential is humongous, it's because people like Warren Buffett with billions and billions of dollars in cash on hand, they don't even look at these small cap companies. It's too risky for them. But the potential, if you hear in what he says earlier, the potential for them to grow is still there. So let's hear what he actually has to say about this.
Hi, I'm Howard Winston from Cincinnati, Ohio. First, I wanted to thank you and Charlie for your sharing your time with us today.
Thank you.
My question is, you have repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold,
do these stocks have names?
Yeah. Well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, I've got this wonderful thing, and I usually know ahead of time, but I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then. Charlie?
Now, earlier I mentioned something about small cap investing as a dividend investor, and I've done some research a little bit myself and came across, as a dividend investor, what is or how would I invest into small cap stocks myself. I do not do this currently. Disclaimer, I do not invest into this company or into this ETF. But I have done some research on it, and as a dividend investor, it's very hard to find small cap stocks where they have a halfway decent dividend yield. Now, you shouldn't always go for the highest dividend yield, so this one still needs returns as well. But one of them that I found was ticker symbol VBR, and this is by Vanguard, which tracks a small cap value index fund, and it is an ETF, exchange traded fund. So it should follow the Russell 2000 index pretty closely. So if we go into the past 5 years, it looks very similar to the Russell 200 or Russell 2000 index fund, and it currently has a yield of 2.23%. I'm not sure how good the growth is on the dividend, but knowing that it is a small cap stock index fund, I'm going to say it's not very good. Whenever it comes to index funds, you can actually see all the individual holdings. So if you go over to holdings, whenever you look up anything on Yahoo Finance is what I'm actually looking now, but you can look it up on a lot of different financial websites, and you actually see the percentage of holdings that they have and what it is. Here it actually shows the sector weightings, which in other financial websites they don't show that. So this ETF, 99.91% is in stocks, and 0.01% is in bonds. So you're not going to be heavily weighted in bonds. Don't ask me why they even have this weighted in bonds. If it's only 0.01%, why even have it in there? I don't know. But as we can see, they haven't had very many earnings growths or nothing to report on. But as we can see, the sector weightings, it shows you in percentage. Basic materials is in this much, consumer this much, financials this much. So with this index fund, you're actually going to be heavily weighted in financial services and industrials. A lot of small cap companies or small companies coming out today, that is actually the sector they're coming out to be in, which makes sense that this index fund is going to be weighted into that sector more often because there's simply more of them. All right, guys, thanks for tuning in. That's going to wrap it up today. I just wanted to let everybody know that I am not a licensed financial advisor, and everything said today is not financial advice. I'm actually long none of these we've actually talked about today. I want to let you know that if you do invest in the stock market, investing always entails risks, and with risks comes the possibility of losing money. Please consult a licensed financial advisor before investing into the stock market yourself. Also wanted to be said that I do have an Instagram. It's under dividend_go-getter. Go ahead and give me a follow. I post updates of my own investment portfolio that you can follow along on a weekly basis. And everyone else, have a good day.